I'm going to be talking about exactly how I would invest $500 during this volatile market. I say $500, but these strategies are going to apply whether you want to invest $100 or $10,000. I'm going to walk you through everything from start to finish, including the big warnings I have, where to invest, how much to invest, what strategies to use to invest, and what to invest in. This is going to be really detailed, so you can use the timestamps in the description if you want to skip ahead to certain parts. And again, this is meant for the complete beginner, but I think it might be interesting for you if you're not a beginner too. And before I jump in, hi, I'm Erica. It's nice to meet you. And I have videos about personal finance on this channel every Tuesday. So first, we need to talk about the big warnings. We are in very uncertain economic times right now. I'm in several business Facebook groups, and every day I'm seeing posts from people about getting laid off from their jobs due to what's happening, or losing a lot of business due to what's happening in this world. If you watched this video where I talked about how to prepare for a recession, one of the very first things that I said is that no one can predict when a recession is going to happen. But there are definitely signs that suggest that more economic uncertainty lies ahead. So my big major warning to you is that, one, if you don't have an emergency fund, or two, if you have high interest debt, I don't think investing is necessarily the right thing for you to be focusing on right now. So for those reasons, I wanted to give you this warning that I think those two things are more important to focus on if you don't have an emergency fund or if you have high interest debt. Now, if you already have an emergency fund and don't have any high interest debt, I think this video is going to be perfect for you. But if you don't have an emergency fund, I just think it's going to be so much more important for you to build up that emergency fund, build up that cash stash in this time of economic uncertainty. The truth is, if we do see a recession, it's going to be much more important for you to have that emergency fund to get you through the difficult times. Let's say in the worst case scenario, if you experience job loss or a decrease in business, than for you to try to invest that money to make a few dollars in the market. Also, if you have high interest debt, I would prioritize paying that off because let's say you have credit card debt at a 10% interest rate, paying that off gives you a guaranteed 10% return on your money. I know a popular quote going around is that more millionaires were made during the Great Recession than at any other time in US history. So I know it's tempting to want to jump on that train and invest and take advantage of these lower stock prices. But my warning to you is just to tread cautiously. I just had to state this. An emergency fund and being cash heavy right now is a lot more important right now. Cash is going to be king. A really good quote by John Maynard Keynes is that the market can stay irrational longer than you can stay solvent. Now that we've gotten that big warning out of the way, let's jump into how to invest that $500. The first question you're going to have is where to invest it. Well, that's step one. You want to ideally be investing it in an account that has tax advantages, like a 401k or a Roth IRA or an HSA. For my retirement accounts, I have those at Charles Schwab and Vanguard. That should really be your first priority, to max out those tax advantaged accounts before you move on to investing in a standard brokerage account. For this example though, I'm going to be showing you my Webull account, which is one of my standard brokerage accounts. Again, standard brokerage account just means that there are no tax benefits to using it. But Webull has a nice interface and is easy to use, so I'll just walk you along with that. And actually with Webull, if you use the link below, open an account and deposit $100, you'll get a free stock. So now that you've decided where to invest your money, so with what type of account and what brokerage, the next step, step two, is to decide how much you want to invest. My advice here is to not invest any more than you feel comfortable losing, especially in these times of economic uncertainty. If you're depending on that money to pay your bills or cushion your emergency fund, don't invest it, especially with the volatility in the market that we've been seeing. You can invest $10 today and lose 30% of that tomorrow. So really think to yourself, how much am I completely comfortable losing? And only then should you invest that amount. So for this example, we're going to use $500. Now you've decided to invest $500. Step three is to decide what strategy are you going to use to invest the money. There are two main strategies, the lump sum strategy or the dollar cost averaging strategy. Lump sum just means that you put everything that you want to invest into the market into the market at once. So for that $500, you're going to invest all $500 today. That's the lump sum method. A study by Vanguard showed that on average, this lump sum method has outperformed the dollar cost averaging method. But given how volatile the market is right now, I would really recommend considering the dollar cost averaging method, which is actually the method that I'm personally going to be using. What does dollar cost averaging mean? Well, instead of putting all $500 into the market at once, with dollar cost averaging, you're gradually easing into the market. With your $500, divide that up. So maybe you're going to invest $100 a week every Tuesday for the next 5 weeks. Or maybe you're going to invest $100 a week every other Tuesday for the next 10 weeks. Or maybe $100 a week every beginning of the month for the next 5 months. Or maybe you're doing, I don't know, $50 a week for the next 10 weeks. You get the idea. It's dividing it up and putting little bits of it into the market instead of putting all $500 in at once. Another way to dollar cost average, and this is actually the strategy that I'm using, is to do it by the percentage change or dollar amount of the individual stock or ETF or mutual fund that you're looking to invest in. And the best way to show you this is through an example. Let's just pretend I want to buy Ford, and the current price is around $5. I won't get into dividends in this video, but just to mention, at this price, the dividend yield is over 10%. I have $500 to invest, but I don't want to put it in all at once. If I were to use the lump sum method and put it all in at once with the share price of $5, I would get 100 shares for my $500. But since the market seems volatile and I'm worried about putting in all of my money at once and I really just want to spread out my risk, I'm going to use the dollar cost averaging method. I'll take that $500 and divide it into 5 $100 chunks. I'll buy $100 worth of Ford now when it's priced at $5. That'll give me 20 shares. Then, when the price decreases 10% down to $4.50, I want to put another $100 into it, and that will get me 22 shares. I want to buy another $100 worth more when it decreases to $4, and that'll get me 25 shares. I'll put in another $100 when it's priced at $3.50. That'll get me 28 shares. And finally, with that last $100, when the stock price for Ford goes to $3, I'll put in that final $100 and that will get me 33 shares. That means at the end of it, I've gotten 128 shares of Ford using the dollar cost averaging method versus the 100 shares of Ford I would have gotten if I had just used the lump sum method. That is the beauty of dollar cost averaging, especially in a volatile market. That's why I think dollar cost averaging is the best method you can use right now, because the market is just very unpredictable right now. No one knows what's going to happen, and no one can time the market despite what anyone tells you. Obviously, everyone wants to buy at the bottom when stocks are at their lowest price. But the fact is, it's not possible to time the market like that. You cannot predict it. If you could, we'd all be millionaires. But I'm not. I'm making 58 cents an hour. So my advice is, just in the current environment, I think the best way you can do it is to use the dollar cost averaging method. Another big benefit is it removes the emotion and just automates the process for you, so it's just very stress-free. With the dollar cost averaging method that I'm using, let me actually show you how I'll do it step by step for those of you who it's your first time investing. So opening the Webull app, I'm going to keep using Ford as an example just because it's the closest stock I could find to $5. Open the app, click on the second icon from the left where it says Markets, and hit that search button and type in Ford and you'll find Ford pop up. It's currently priced at $5.63. I'm going to hit trade, and the next thing that pops up is the two choices that I want to focus on. One says limit and one says market. Market means that you buy it at the best available price. I never recommend using this option because the price could spike and just completely throw you off. Even if you're okay buying it at the current price, which is $5.63, you still want to do it through a limit order. Using this limit order, you can say that the maximum price you're willing to pay for one share of Ford is $5.63. Limit order just basically means that that is the maximum price you're willing to pay for one share of that stock. So at $5.63, that means you're willing to pay $5.63 or anything lower. So you might end up paying $5.63 if you put in a limit order for $5.63, or you might end up paying $5.50. It just depends on what price point you get filled at. Since in our example, we said that we wanted to buy 20 shares at $5, I'm going to put in a limit order at $5. So I'll change that price from $5.63 to $5. For quantity, I'll set that to 20 because again, I wanted to spend $100, so 5 times 20 equals 100. What that just means is when the price of 4 drops down to $5 or less, Webull will automatically buy it for me. Where it says time in force, your choices are day or GTC. Day just means that it's good for the day. So if during that trading day, the price drops down to $5 or less, your order will get filled. If it doesn't, then your order gets canceled. GTC means good till canceled, and that means that if within the period of the next 60 days, the price drops down to $5 or less, your order will get filled. If it doesn't within those 60 days, then your order just gets canceled. If you're happy with that, then you click buy. So for dollar cost averaging and given this current volatile market, that's the strategy I'm using. Once I've submitted that order, then if I'm going along with the example that we did earlier, then the next step is to put in a limit order for $4.50. And again, I'm putting $100 towards each step. So at $4.50, that'll actually get me 22 shares instead of the 20. Before we go into step 4, if I haven't convinced you yet why dollar cost averaging is the best method to use right now, I have just one more trick up my sleeve, one more thing I can show you that I think will convince you. This is the historical chart for the Dow Jones Stock Market Index. You can obviously see the Great Recession here during 2008, 2009, and what happened to the market. If you would have decided to use the lump sum method, let's say you put in all $500 when the market was 10% down from the peak. You might have felt really good about it until the market continued to drop. Because if you look from the very top of that peak to the bottom, that's about a 50% drop. So while you felt good about getting a 10% discount, I'm sure it didn't feel good when it dropped an additional 40% after you put all of your money in at once. When you use the dollar cost averaging method, you're basically getting in at different points. You're spreading out that risk. If you divide your $500 into, say, 5 $100 investments, maybe you're getting in at these 5 points. Or these 5 points. You have no way of knowing, but the great thing is you're not putting all of your eggs into one basket the same way that you would be doing with the lump sum method. The thing is, we just don't know where the bottom is. Maybe things could recover from here and everything goes on just fine. Or maybe things could get much worse from here and drop an additional 30, 40, 50%. No one knows where the bottom is, and anyone that tells you they do is not being truthful. One thing that we know is the market is very volatile right now. We could be at the very bottom, or we could just be at the very beginning of that long drop. We have no idea of knowing. That's why at the very beginning of this video, I said the one thing that's really important to know is that cash is king, and don't invest any more money than you're comfortable losing because it's just so unpredictable. Now onto the fun stuff, step 4. So with step 3, you've decided what strategy you're going to use, whether you're going to go all in at once using lump sum or trickle into the market gradually using the dollar cost averaging method. Now the fun stuff is deciding what you actually want to invest in. 2 choices here. The first choice is individual stocks, meaning that you invest directly into that company, like Apple or Facebook or Amazon. The second choice is investing into mutual funds or ETFs, exchange traded funds. Many, if not most, mutual funds and ETFs are index funds. When you buy an index fund, you're buying a collection of stocks or a basket of stocks designed to track a certain index, like the S&P 500 or the Dow Jones Industrial Average. That means that instead of buying one share in one company, like an individual stock of Apple, you're owning tiny bits of many different companies. What is my preference? My preference is buying these index funds because I just think it's a great way to diversify and not have to think about it and reduce the risk. If you watched one of my older videos, I talked about why Warren Buffett prefers index funds and recommends them for the majority of people, and I think that's worth a watch if you have time. Ultimately, it's up to you though whether you want to do an individual stock or an index fund. If you do an individual stock, then just showing you on my app, you'll click in, search, let's say Apple, click trade, set the limit order, and then buy. Now, if you opt to do an index fund, there are so many choices out there, and I don't want you to get overwhelmed, so I'm just going to walk you through 3 examples of different index funds that you could choose from. I tend to like Vanguard ETFs, so Vanguard has a nice list here of 74 ETFs it offers. I like how they have it organized into 5 different categories: US bond ETFs, US stock ETFs, international bond ETFs, international stock ETFs, and sector and specialty ETFs. I'm going to focus on US stock ETFs, and let's take a look at 3 of the popular ones: VUG, VTI, and VOO. VUG tracks the performance of the CRSP US Large Cap Growth Index, the Center for Research in Security Prices. You're going to see a lot of technology companies in this one, so if you actually scroll down, you'll see that the 10 largest holdings, which represent over 42% of total net assets, are these 10 companies, which I'm sure you probably recognize all of these names. That means that by buying this ETF called VUG, you're going to own little bits of each of these companies among other companies. VOO invests in stocks in the S&P 500 index. Again, scrolling down, you're going to own bits of these companies and many more. Clicking on this Portfolio and Management tab, you're going to own tiny bits of 508 different stocks. VTI seeks to track the performance of the CRSP US Total Market Index. So clicking on this Portfolio Management tab, you're going to own tiny bits of 3,551 different stocks. Let's say that you like one of these ETFs that I just walked you through, or any of the other 74 ETFs that Vanguard has. First choice is you can buy them through Vanguard by opening a brokerage account with Vanguard, or if you want to stick with the Webull theme, you can click on the Webull app, search for it, for example VUG, find it and purchase it there. I know that was a lot of information, but I really just wanted to make a comprehensive guide for the complete beginner, someone who's brand new to investing, how to go from not knowing anything to completing all 4 steps and investing your money. So hopefully that was helpful. I'm going to do a recap just because I know it was probably information overload, and this recap will help you focus on what exactly the 4 steps were. Step 1 is where to invest. What kind of account are you going to invest through? Are you going to invest through a Roth IRA, a 401k, other retirement account, or maybe a standard brokerage account? Once you've decided that, which brokerage do you want to use? There's so many options here that I'll pop up on the screen. For this video, we've been using Webull just because if you use my link and deposit $100, you'll get a free stock, so I thought that would be fun. But to be honest with you, I have Webull, Robinhood, M1 Finance, Charles Schwab, and Vanguard. So it's really up to your preference. There are so many options out there. Step 2 is how much do you want to invest? Given how volatile the market is right now, I would not recommend investing any more than you feel comfortable losing. Step 3 is to decide which strategy you want to use to invest. Do you want to use the lump sum method or the dollar cost averaging method? Finally, step 4 is what do you want to invest in? Do you want to invest in individual stocks like Apple or Microsoft? Or do you want to invest in mutual funds or ETFs that have a basket of stocks in them? One thing I have to say is don't be intimidated if all of this didn't make sense the first time round. One of the biggest barriers to entry for investing is, I think, just intimidation. People are scared about what they don't know. They feel uncomfortable with all of these terms that they're unfamiliar with. And trust me, I was there too. Everyone begins as a beginner. The thing is, it's a learn and go process. Ask questions. Ask me questions in the comments. If you don't feel comfortable doing that, send me a private DM on Instagram. I'm happy to answer all of your questions because I know that this can be really intimidating and overwhelming at the beginning, but trust me when I say that once you start investing and get a little more comfortable and familiar with these terms and how the process works, you'll feel really good about the fact that you started and didn't let that intimidation or scare factor deter you from doing that. Honestly, I think it's a great time to learn about the market and start investing because especially with how volatile the market is, you're going to learn a lot. You're going to get a very speedy introduction to how to have patience, how to invest without emotion, and a lot of other things. Again, as long as you pay attention to the warnings that I gave you at the beginning, don't invest more than you're comfortable losing, don't invest if you don't have an emergency fund, and don't invest if you have high interest debt, I think you're good. My name is Erica. I make videos about personal finance on this channel every Tuesday, and if you enjoyed this video, please give it a thumbs up and share it with a friend. And this is a very important video, so I'm going to see you there next.